You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I'm Bill Powers. It's Mining Stock Education. Thanks for tuning in. Joining me today for a conversation about the junior mining markets is Joe Mazumdar, the expert over at ExplorationInsights.com. Joe, thanks for coming back on the show. Let's start with your commentary on the Gold Fields-Yamana merger. I always like to have you on the show to discuss these mergers and acquisitions and whether they're good, the pros and cons. So could you start with your analysis of this, please?
Sure. Thanks for the invite again, Bill. It's always a pleasure. So in terms of Gold Fields-Yamana, if I had to strike a parallel in terms of that merger, I would say it was very similar to Gold Corp and Newmont, that acquisition. That acquisition did not have a lot of synergies between them. And so it took the market a little bit by surprise that those two would merge. And that was just a merger for scale, a bit of diversification, I guess. But like in terms of synergies, like let's say creating Nevada gold mines or something like that in Nevada, there was not a lot of value to be realized from that merger other than G&A, because there was not a lot of operations that were that you could have levered off of. But from Gold Fields' perspective, they wanted to, diversify out of South Africa. This gets them, 50%, I believe, in Canadian Malartic, a significant gold deposit in Canada. It was a $6.7 billion transaction, but it was all shares, right? And so this is the tricky part, is that, Gold Fields needs 75% of their shareholders to approve it. Yamana needs 66 2/3. And so there was a lot of turnover in Gold Fields shares after the announcement. They took a significant hit. They fell like over 25% on 8 times average volume. And so the theory right now is that potentially they've turned over all the shareholders that were against the deal have already left. And so the probability now that they can get that 75% hurdle is actually better. But in terms of what I see is that I think Gold Fields had the near-term production. They beat Yamana on that. They've got more reserves. They've got all the near-term sort of valuations, but it's really the upside in Yamana. And the big upside in Yamana, I believe, is the Agua Rica deposit in Argentina, which is a large porphyry copper gold deposit. Glencore have Bajo de Lumbrera, and that plant still is there, and they don't want to pay reclamation and shut everything down because Bajo de Lumbrera, the mine, is over, and they want to truck or bring that ore from Agua Rica and treat it at that facility. And so that's the big impetus to make that whole complex work. And gold, it's mostly a copper deposit, but gold equivalent wise, it's about 40 million ounces. So if they can make that work, that would be a significant step up for Gold Fields. But again, not a merger that made a lot of sense. A diversification from Gold Fields' perspective, still a bit of risk to see if the merger actually happens. But again, it was mostly for scale.
Sometimes when we see these big mergers at the gold producer level, it can indicate a near-term bottom in the gold sector. Do you see this as an indicator of a potential bottom right now?
I would say that there's because the other merger of equals that were happening was as the market was going up. Usually, they tend to be better at sort of predicting that the market's getting tighter and it's time to start acquiring and getting scale because the market's looking to improve.
Wasn't Randgold and Barrick at a bottom though in 2018?
Yeah, but
I believe
it's a bottom. Yeah, like you said, bottom anticipating a rise. But this one is sort of more like Newmont and Gold Corp. Newmont and Gold Corp. That merger needed to happen for that CEO because he wanted that sort of thing. And Gold Fields had a major CEO change. So they went from Nick Hollins to the new guy, and the new guy wants to put his print on the new company, on Gold Fields. And this puts his badge on it, good or bad, with the Yamana deal. And so, a lot of this is ego driven. Besides Yamana,
not change of control fee driven.
yeah, for Yamana. But
Okay.
I mean, if you look, the break fee to Yamana is about 450 million US.
Wow.
And so that would take care of their net debt position. So for Yamana, it's a win-win. Either they get a liquidity moment, they own more shares in a more liquid company that they can sell, but also they, if it doesn't work out, they get $450 million of cash that they didn't have. So for Yamana shareholders, and that it's perfect. For Gold Fields, most of those guys that didn't like it are the ones that sold.
Joe, when discussing near-term bottoms in the junior gold sector, what are some things you look for? People analyze the GDXJ relative to GLD, inflow of funds. What are the metrics or things you look for when you're trying to time a near-term bottom?
Well, it's the amount of 52-week lows alerts that keep popping up on my phone.
And they keep going lower.
That's a bloody good indicator. The other one was it'd be financings, how much harder it is to get financing, the kind of hurdles, you're raising less money, but it's more expensive, bigger discount to the share price. A full warrant versus a half warrant to no warrant, not that big of a premium on the warrant, maybe a longer warrant. So that sort of thing, private equity coming in and loaning you money, maybe people doing more royalties and selling more streams because the market's not there for equity and their project is not valued very highly. So in this kind of market, it's not, equity. Raising equity is much more dilutive than potentially diluting your project, because interestingly, like if you looked at Alexco, that was a silver company in the Yukon. It got bought out by Hecla. And again, most producers over the last
like a
2 years,
decade low share price, though, right? Something like that.
Yeah, exactly. But the Heclas of the world and that mostly have decent balance sheets, low debt, and so they can make these transactions. Granted, this transaction was all shares again, but they took these guys out for, like you said, at the lowest of the low. But if you look at Alexco's circumstances, they have a very small underground plant of 400 ton per day, which is not very big. They couldn't even feed that because of the massive amount for them underground development that they required. And they could never feed that plant enough to generate enough free cash flow to get enough underground development to keep the ball rolling. And so they basically suspended their operation, milling, and did more underground development. But then they would have to go finance that underground development, and nobody right now was going to give them money for that. And so, their options was probably a very dilutive financing, loan to own with some private equity firm, or getting bought out for shares. And that's what they chose. But interestingly, the stream that they bought from Wheaton, which basically hindered their ability to generate free cash flow, that was worth more than the company. And so that is a good sort of highlight for anybody to say, if you put a stream on your main product, and cut your leverage out in terms of good times for silver price, because you've got this stream and you never accumulated.
It was $4 an ounce too, right? Something like that.
Exactly. And they can't do another stream now, obviously, to raise money to do underground development, but they were never making any money, ever. And so it was only the silver fanatics that would buy this stock, because they would drill something and go, oh, look at the high grade, but they would never generate any free cash flow from them. So they ended up where they ended up, partly because of the silver price, the lack of funding or capacity or access to capital to fund underground development, and mostly because of the stream. And so whenever you're looking at a company with a stream on the main product, that's what you got to think of, is that when they actually get going, how much money are they actually going to make? Because I can tell you that in the royalty market, that recent transaction with Great Bear, it was all cash. And so there's not a lot of M&A that's happening for an exploration company or a developing company or even a producer that's all cash. It's mostly shares. They're offering all cash because royalty companies also have decent balance sheets, but there's so much more competition for royalties and streams. The only way to get this over would be all cash. And so that's another gauge of the market. One's much more intense in terms of supply and demand fundamentals, is much better for royalties and streams. There's a whole bunch of royalty companies, very few assets, so the value of each royalty and stream is much higher, and these guys have the cash to pay for it. Whereas on the other side, it's not the same case, and so it's a lot more paper transactions, and most of the premiums that they offer disappear within a week.
You mentioned Great Bear. They spun out the royalty company before selling to Kinross, and Royal Gold is buying that for 200 million Canadian. What's your analysis of?
Well, and then again, that's a 51% premium. That's a brilliant sort of outcome for the Great Bear shareholders.
It's like $2 billion when you add the two transactions together, right?
$2 billion Canadian. Yeah, it was 1.8 and 0.2. So a great outcome. And they could do that because there was not any significant royalties on that zone, so they can issue one to themselves. As opposed to selling it to a royalty company for cash, they created a company that held it. So that's a brilliant move.
Do you see that strategy playing out more often in the junior space then as a result of this success?
I would say, but I mean, you'd need an asset that has almost 0% royalties, because the more royalties you start putting on an asset, the less of a takeout target or appealing it becomes. So you want to watch it to make sure that you stay below 5%. Otherwise it gets kind of too much for a company when they look at what they're buying.
What about Rio2? They had an environmental permit denied. What's your analysis of this situation, Joe? And some people have extrapolated from this that, Chile is now a bad jurisdiction. Permitting is not going to move forward. The government's moving left. In my opinion, I think people are reading a little bit too much into the country as a whole as a result of this one specific issue. What would be your analysis here?
I mean, the thing is that Rio2, I don't own shares of that company, but they have their big push. I mean, why this was created was they did a good job with Rio Alto. They brought on that heap leach project in Peru, and that got sold to Tahoe, and they had a big win for management. And so when they created a new company, they wanted to do another open pit heap leach. Hey, we're good at this. Let's look around the world. Where can we go? It's got to be oxide, got to be heap leach, open pit amenable, blah, blah, blah. Look through the states. And then their concern was that the states takes too long to permit. It was the permitting risk that stopped them from going.
Well, I would agree with that too, though.
Yeah. So, but maybe not. But I mean, it's it used to be transparent until we had the trilogy event. But if we take that, that's perfectly justified in that. And so they go to Chile and they say, well, we can do this in 18 months. And there's a recent precedent for it from Salares Norte, where that was done around that sort of time frame, and that was an open pit heap leach at altitude as well in northern Chile. So, okay, let's do this and let's fast track this thing. And so the original mine plan with the former company, which Atacama Pacific, was to have like an 80,000 ton per day operation with the production profile from this open pit heap leach in the Andes at about 4,500 meters plus or whatever, to generate a big enough production profile that they would get a suitor to buy the company because it was so big. But since these guys want to build it, there's no way they're going to build an 80,000 ton per day plant. And so they're going to build a 20,000 ton per day heap leach, something much more that they could do. But then, that was a lower capital, but they were hoping that would be faster to permit as well, because they would avoid some of the other things that the 80,000 ton per day plant needed. But problematically, the water was a pipeline before, because they needed a lot more water. Then they got it down to, I think, 24 liters per second, but then they were trucking it. and they're talking about 70 trucks per day in my calculations going up and down that road, delivering water. I think it's 190 kilometers. So I'm not sure if that impacts the fauna that these guys are talking about, the viscachas, the guanacos, and the llamas. I don't know, but they're telling us that where the plant is and where the mine is, these animals don't exist. So it's got to be somewhere between there and down below that they're impacting. But then if I had to look at this as an isolated incident, then we have the Los Andes Copper, and their operation was a suspended environmental license, again for fauna, a viscacha. And then somebody else sent me a newspaper article that they're going to relook at the permit that was already given to Salares Norte Gold Fields, which is in development, close to first pour. And so that sort of indicates to me that
and that's an animal issue too for that one?
I don't know what it is,
okay.
But it's just that the fact that they're opening it up again, that scares me. So I between the previous government and this government, yeah, you want to keep your head down, but they'll be looking at any new projects with more disdain, and especially, because the permitting apparently is done at a regional level, not at a federal level, but apparently Rio's studies, EIS components of it were brought up to a federal level, and that's when it got funny.
So the projects I like in the States the most are the ones that don't have to deal with the federal government or have to deal the least amount with the federal government.
Oh yeah, absolutely. And when we talk about companies, that's basically why I invested in this other company. The same sort of reason is because I want to cut out that risk.
So what is the biggest risk in the second half of this year for mining investors?
Yeah, well, it depends on what you're investing in terms of commodity, precious metals. I mean, higher interest rates will give them a negative sentiment towards gold price. And so it's flat to down. But problematically, that's not a bad price. But the issue is that the higher costs impacting producers and developers are sort of eating into their returns and eating into their margins. And so if you look at institutional equity or anybody, their big problem is that why would I invest in somebody with shrinking margins? So that's, but what I think Gold Fields and the merger with Yamana, that CEO is saying, hey, we're going to increase our dividends to attract those other kind of investors. But then you would question, like, how sustainable are those dividends? But then you also got to think as an investor, can they grow if all their free cash flow is now going to dividends and not going to growth? And then you could turn it around and say, okay, well, then M&A has to go up. And so that's one positive about the precious metal sector and maybe where we are right now. And I've been harping on this for a while, we're going to see more M&A. But the problem is that are we going to see M&A with decent premiums? Obviously, the Great Bear one was a decent premium and it was cash. Are we going to see that for any other companies? I would say potentially in the royalty and streaming sector, potentially, but maybe not at a lot of the other assets level because, their shareholders might just be happy with a liquidity moment and shares in a more liquid company to ride this out.
What about Equinox Gold, multi-year low, all-time lows actually, and other gold producers? Do they catch your eye at this point?
Well, then again, the problem is margins, but in terms of balance sheet, they're in a better spot, most of them, to ride out the issue with the margins in the short term, but they'll pull back from development projects. They'll pull back because you don't want to be using your shrinking margin to fund an escalating capital development project. So that's why a lot of the M&A we've seen has been into production and not necessarily development in the gold sector.
Yeah, that makes sense. Can you leave us with a junior mining stock pick, a recent pick?
Okay, like one of my top picks and a site visit I just made several weeks ago to Southeast Arizona. My previous stomping grounds in the early 2000s was Arizona Sonora Copper, and this IPO'd last year. It's got importantly private ground in that part of Arizona, not far from Casa Grande. Importantly, because of the drought conditions in that part of the U.S., they have water. They have more water than they need.
And you're referencing Resolution Copper, right? That has the issues in Arizona.
Yeah, Resolution, Rosemont, these sort of things that have their, issues, let's just say. And even permitting for South 32 with the Taylor deposit, they still, can't access a lot of ground to drill, and so they have to drill from underground. So so private is very important. Access to water, and the water that they're accessing is non-potable, so they're not competing with the cities for that water. It's more like effluent if they make a deal with that, but it's water that people don't want. And then they've got grid power because they're close to infrastructure. It's a former mine site as well, so it should be easier to permit. And importantly, they have exploration upside, which they're drilling right now. And then add on to that, to the southwest, Robert Friedland's new IPO, which one is the biggest IPO in the last several months because there haven't been a lot of IPOs, is Ivanhoe Electric. And so one of their two flagship deposits or projects is called Santa Cruz, which is right to the southwest of where Arizona Sonora is with their Cactus and Park Salyer project. So you get one of the biggest promoters and successful mining magnates right there with his company that recently IPO'd and raised $170 million US right there. And then you're right here. The thing that makes the most sense is a potential consolidation of the entire area, not only for resource, but also for infrastructure, for water, and for ground, private ground that you could put things. So for me, that makes a lot of sense. But in terms of Arizona Sonora, they've got funding to build out their part of the story resource-wise. And now just recently, they did a private placement with Rio Tinto Technologies called Newton to basically try to leach the sulfide ore, the primary sulfide ore, because most of what they're drilling is enriched chalcocite, which you can do a solvent extraction electrowinning. But Newton is trying a different process that's proprietary to Rio Tinto to actually leach the sulfide, which is something these guys have not put into their resource because they haven't thought about actually developing that. So you got a lot of things working for them, but it's not a great market to say, okay, who's going to be the next person that's going to buy this? But it's one that if you've got a longer term window of investment, this is one that I would look at.
And that would be like a 3 to 5 year hold when you say longer term. Would that be kind of
at least three. I would say 2 to 3. Yeah,
because copper projects take at least 5 years to build, right? Any copper project of scale.
Yeah, but I'm not even thinking that this needs to build for us to get the liquidity event. What we need is to build up the major sources of value, which is the resource, infrastructure, the metallurgy, all that sort of stuff's got to be built up to add more value to your end, to generate a consolidation of the district. And that consolidation might bring in a bigger player to the area. So yeah, that's what I would look at with respect to Arizona Sonora. But again, if you buy it and it goes down 5%, I mean, don't worry about it. Just because right now, like you said, with the recession perspective, copper's gone down quite a bit. Yep. But the problem was on the supply side, like because of permitting, because of a lack of successful exploration, the costs of development and things like that. There's not a lot of new projects coming on that are going to satiate that market going forward. And so, whatever you think about demand, we don't have a lot of supply coming on. And so if we look at that 2025 plus window, what are the projects that are going to fill that window? Like Resolution that you just mentioned, when I worked as an analyst for Phelps Dodge in Phoenix, we had that project coming on in 2010. It's 2022 right now. Yeah. So, and they've spent quite a bit of money on it since. So that's that. And
is that where African copper projects are a little more attractive because you don't have a lot of the permitting hurdles that we have here in the States?
Well, I mean, in some of these countries, you could have issues with expropriation, creeping nationalism, where they expand the royalty or they take a bigger chunk of the free carry. But permitting, because they have the free carry and they're the government, is pretty well done. You're good with that. It's not a problem. But then if you change regime and then they say, oh, like they're doing in Zambia. Right now, Zambia's got a really good president, and he's from the area in northern Zambia where the Zambian copper belt is. But he's re-looking at a lot of the permits that were given to other people under a more corrupt regime and trying to say, oh, how did you get that anyway? So everybody is very positive on Zambia right now in terms of the way that president's taking it. But then you have to look at it from a long-term perspective. This guy, is he going to be here for 4 years, 10 years, or whatever? And how long is he going to have this positive attitude? But definitely the way you're thinking right now, Zambia has a lot of potential, and a lot of places in Africa have potential, but that's the other risk you take.
Yep. Well, Joe, thanks for your insights. Your website is explorationinsights.com. Anything new there that listeners should know about?
So I did an investing clock for the gold sector, and that's a presentation I did at the Metals Investment Forum. So that's on YouTube as well as on our website, and then also I've got a sort of a free version of what I produced for subscribers a couple of months ago. That's on our website that you can take a look at.
Excellent. Well, thank you for coming on today's show.
Okay, thank you very much, Bill. We'll talk to you later.